Good evening. Thank you so much for joining us. We are going to cover payment frequencies today. So payment frequencies are kind of like a strange topic to cover, but you'd be surprised what you can learn from it. So I'm hoping that we'll all get quite a bit from it also. And so we want to talk about payment frequencies because it is actually one of the most neglected things about your mortgage that people are frankly unaware of. And to remind you, this is the 10th article we're doing in what's called our mortgage life cycle series. And you'll see now why we do this kind of series, because what is that for a title, Jacques? Mortgage life cycle costs, okay? And the reason for that is because we write these articles because there's such an over focus on interest rates that people are actually neglecting major criteria that is costing them dearly at the end of the day. And why would I say that, hey, why don't overfocus on interest rates? The first thing that comes to mind, this guy's lost his mind, because of course interest rate determines what you're going to pay. So why would you not focus on interest rate there? Well, here's why. We've literally seen people, suffer loss because of an overfocus on interest rate. And here is why. Okay, and this is important. If somebody who gets what I'm about to say, literally their eyes will go open up and they will not be caught again by clever tricks. So Canada's largest banks are what we call a saturated oligopoly. Now that is a very big name. Saturated meaning the market is not able to expand. If you're a bank in Canada, you can't really go out and get another 100,000 customers because pretty much everybody that's got a mortgage has got a mortgage. So really what you got to do is you got to take from other people, okay? That's what a saturated oligopoly is. There really is no more room for another bank to enter in the size of the big five or big six, okay? So what is an oligopoly? An oligopoly basically, it means they're independent of each other and usually don't risk competing by price or interest rates. Why? So what is oligopoly? So oligopoly, again, unlike a monopoly where there's one entity controlling everything, oligopoly, there's a few, but very big, very large. Okay, so our banks are all significant. The big five, big six are significant in size. Okay, often the biggest, in some cases, the biggest in the world. So in other words, very deep pockets. If these banks decide to compete with each other on interest rates, well, it's a race to the bottom, right? The only one who's going to win with that is the consumer, and maybe in the end the consumer not even. So basically, they would just drive each other into the ground. So what oligopolists literally do is they go, hey, listen, let's not compete by price. We're going to kill each other if we do that. So what they do is, how do they compete? They literally compete by image, and here is the kicker: by retention. In other words, if somebody does not, if entities don't compete interest rates, okay, let's see if that's true. Well, go to your bank's website and see what their interest rates are. They are really very close to each other. There's not much in them at all. I mean, they just will, if the one is that much higher than the other ones, it's not going to make it, right? So in other words, frankly, when it comes to retention, it's really by clever tricks. They compete by retention. So that's where's retention? So it means a few things. Banks is, for argument's sake, we think that prime rates are the same for all banks, right? They are not, okay? Prime rate can be very individual to banks. You'll see some banks have a higher prime rate than other banks. Also, the terms and conditions is where they compete in, and we see this every day, how our banks do this kind of stuff, okay? So consequently, we caution people, since it's an oligopoly, not to overfocus on interest rate because it's going to blind you. You're going to turn a blind eye unintentionally to mortgage factors that will cost you a lot more than a small difference between two interest rates. Okay, and so that is why we write this, because most people say, "What's the interest rate?" And I go, "It really is about the right mortgage," and people don't really believe it, and so that's why we write this here. Okay, cool. So for the preamble there. Okay, so we're going to talk about mortgage payment frequencies. So again, why spend so much time on it? Simply because there is an overfocus on interest rates. So most people tune out to anything else that really could advantage them or actually disadvantage them, okay? So payment frequencies are either treated as an afterthought by banks, like, yeah, whatever, you want biweekly, sure, no problem. Nobody explains anything, nobody educates, right? And then the other side is some people think that more payments will actually pay your mortgage off quicker, right? I'm not talking about bigger payments, I'm talking more payments, 24 versus 12. They think it's going to actually pay the mortgage off quicker. Well, we'll see in a second what the results are, okay? And so hopefully with these articles, you'll be able to say, no, I want this for my mortgage and pay it off quickly. Let's look at payment frequencies for your mortgage, okay? So let's just determine what we mean with payment frequency. It's basically, in a very simply put, it is the amount of payments you make every year. Okay, so in other words, monthly, semi-monthly, weekly, bi-weekly, those are essentially payment frequencies. Okay, and so that's what we're going to be looking into today. So very important for you to note, very important, is that monthly payments are actually they represent the standard mortgage in Canada. So in other words, the other ones like biweekly and all those kind of things, they are deemed to be privileges. So if a client does not manage them, let's just say a client chooses biweekly payments and they don't manage those payments well, or they miss a payment or something like that, the bank has every right to ask them to come back to monthly payments, okay? Because the other payments are deemed to be a privilege, okay? Very important to understand. So for us in the mortgage industry, our disclosure basically says 25 years and monthly payments is the standard mortgage in Canada, okay? So important to note that. So monthly is if you get biweekly, a bank has the right to ask you to go back to monthly payments, okay? All right, so while most banks do offer all of the payment frequencies, not everyone do, okay? So it's important to understand that. So if a bank, some banks may say you can only pay monthly and you can only pay it on one day of the month, okay? And there's actually quite a few, not a few, but there are some who do that. So important to, so don't assume for a second that you'll get, monthly, biweekly, accelerate, all of that with a bank. You may not. So it's important to look into that stuff. I always say the most dangerous thing about anything is the assumption that everybody has it, right? Because then you don't look into it, right? So it's always make sure that when you do mortgages, go into it with a blank slate and ask all the questions, because you're going to be surprised. We do this every single day. Okay, so here's the magic table. All right, so this is basically gives you the magic of how to calculate mortgages. So let's go down to this here and then we'll come back. Okay, so here's how you calculate, and I'm not trying to make you math whiz, I promise you, okay? But what you do is to calculate other payment frequencies. Monthly, you have to start with a mortgage calculator, okay? It is not a linear calculation, it is a exponential calculation. So you need to use, obviously you can build your own calculators, that's what I do, but you need to use a calculator to calculate your monthly payment. That's it, you got to start there, okay? Then here's your next step, and we'll look at the table in a second. Your next step is you annualize that mortgage payment. So let's just say we calculate your mortgage payment to be $1,000 a month. Then what you do is if you have non-accelerated payments, so biweekly as opposed to accelerated biweekly, if it's just biweekly, you take that monthly payment, $1,000, you multiply it by 12 and you annualize it, okay? Now, if it's accelerated payment, this is the kicker right here. I'm just giving you a tip. Accelerated, you multiply by 13. Okay, so now you take 12 payments, you analyze it, but then you add a 13th payment to the other 12. So now you have 13 payments, okay? Then step 3, you divide the annualized mortgage payments by the number of payments per year associated with the payment frequency. So if it's bi-weekly, you divide it by 26. If it's weekly, divided by 52. So simply put, step 1, you take a mortgage calculator, calculate the payment. Then to annualize it, if it's non-accelerated, like bi-weekly, you multiply by 12. If it's accelerated, you multiply by 13. Step 3, divided by the amount of payments per year, okay? So let's look at the table now. It'll make more sense to you now. Now, this is actually quite funny. You'll see in a second, it really gets quite, well, funny in a weird way, okay? So monthly payments, of course, there's 12 a year. You make one payment per month, and you calculate that by a mortgage calculator. And let's just say, for example, we get $1,000 a month. Okay. To calculate semi-monthly, so people ask me, what's the difference between semi-monthly and bi-weekly? Semi-monthly is typically paid twice a month, where bi-weekly is paid 26 times a year. So twice, 2 months a year, there are actually 3 payments in that in those months. Okay, so semi-monthly is actually 24 payments a year. So semi-monthly payments are either on the 1st or the 15th of the month, every month exactly the same thing. Another thing where it differs from bi-weekly is it's never the same day every month, right? So if it's the 2nd of the month, then 14th to 16th, and so it's never really the same day of the month. Where semi-monthly, it's either the 1st or the 15th or the 16th and the 30th, so it's always the same. Okay, so twice per month, that's the big difference. So to calculate your semi-monthly payments, you take the times 12, right? Annualize it, divided by 24. Now, of course, 12 over 24 is just a half. So basically, to calculate your semi-monthly payments, you take your monthly payment divided by 2. So 1,000 times 12 divided by 24 gives you $500 semi-monthly. Okay, remember we started with $1,000 a month payment. Okay, bi-weekly, there are 26 payments per year, right? So every 2 weeks you pay that mortgage. So monthly payments times 12 is not accelerated, divided by 26, and you can see here you have a 461 and 54 cents. Now there isn't a direct, nice, cute kind of round fraction here. Okay, so that's why it kind of stays that way. Okay, so watch now, accelerated bi-weekly. We take the monthly payment times 13, as we just discussed, divide that by 26, and of course 13 divided by 26 is a half, and so monthly payment divided by 2 is 500. So you're like, whoa, wait, Jacques, how can bi-weekly be the same as semi-monthly? Well, remember, this is $500 times 24, where this is $500 times 26. There is a difference. It kind of can be a bit confusing, okay? If we do weekly, again, we take monthly and times 12 divided by 52. There's your weekly payment. And accelerate weekly, again, times 13 divided by 52. It is a quarter. 13 divided by 52 is a quarter. And so $250 every week. And so you can see what we just said, by adding a 13th payment to it, you can see of course, that your accelerated biweekly is bigger than your biweekly, and your accelerated weekly is bigger in number than your weekly. Okay, and we're going to come back to this in a second, because you should probably, wait, Jacques, why is there no accelerated monthly? We'll talk about that in a second, okay, or accelerated semi-monthly. I personally think we'll talk about that is because there's no cute fraction. Because I'm surprised. You go to so many mortgage companies and they'll say, yeah, to get biweekly accelerated divided by 2, blah, blah, blah. But there isn't a whole fraction that you can use for semi-monthly accelerated, because it'll be 13 divided by 24. It's like a messy fraction, okay? So you'd have to say to somebody, to get semi-monthly accelerated, you have to divide by like 1.6567 or something ridiculous, right? So it really wouldn't make sense for people to do that. But I'll show you a trick. You can calculate your own in a second. All right. So let's go down here. I hope this is not too complex and too mathy for you guys. But I remember this will be uploaded also when it's all done. All right. Okay, so we talked about the manual calculations, how you do it. And I do that because I'm a why person, okay? I don't like it when people just say to me, no, just don't worry about it. You just do it. I'm not that kind of person. I kind of want to know the why, because then when I know the why, I understand. When I understand, I can do it by conviction, not robotically, okay? Okay, so again, why do I show you why? Is because you understand it. When you understand it, you can, if a bank tries to sell you a bunch of nonsense and you understand it, you can just go, forget it. I'm not interested in learning that. That's why I show you. All right. So this is important. Now we're getting to the crux of it. So the question we asked in the beginning, if you make more payments, in other words, if you make bi-weekly payments, will you pay your mortgage off quicker than monthly payments, or weekly versus monthly payments? Will you pay your mortgage off quicker? Now, understanding you got to peg one thing to get a result. So what do we peg? We're going to peg compounding. So when we say compounding, compounding means is how often is interest added on top of interest. So when something is compounded semi-annually, like fixed rates mortgages have to in Canada. By law, they can either be compounded semi-annually or annually. Banks choose semi-annual because they get a little bit more interest. Okay, and so when you talk, we talk about when I mention this year. Now I'm going to say that we assume that all of the mortgages are going to be semi-annually compounded. Okay, then watch this. If all things being equal, semi-monthly, bi-weekly, or weekly payments may save you a little bit of interest, but making minimum mandatory payments more than 12 months a year do not pay your mortgages off by themselves. It does not. I'll show you the results in a second. Now, when you start messing around with compounding, like monthly, then you're going to have slightly different compounding, right? And so some variable rates can be monthly compounded. Be cautious about that, okay? But if you then, here's where it gets really funky. If you pay extra money in your mortgage, like you don't just make your minimum mandatory payments, and I know this definitely people in this in this webinar who really drive their mortgage very well down and really quite aggressively, but very responsibly, which I'm so proud of you for doing. But if you do that, if you pay extra and then you consider the compounding, yes, then you are going to be having a benefit. But if you just take everything being equal, you do not pay your mortgage off quicker if you pay bi-weekly or semi-monthly versus monthly. If you pay accelerated bi-weekly, yes, you do. But as we discussed before, you pay it off quicker because of the additional payments you make, not the additional amounts you add to the payments, not because you're paying bi-weekly, so to speak, okay? So let's talk about the accelerated. I've kind of jumped ahead of myself a little bit. So what are accelerated payments, okay? So there's such a myth in accelerated payments. The sad thing is, frankly, is if you went to your bank today and said, can you explain to me how do I calculate my accelerated bi-weekly payments? I'll go, oh, no, that's easy. Take your monthly payment divided by 2. And you go, okay, thank you very much. But can you explain to me why do I divide it by 2? And I'm not being derogatory or demeaning. They wouldn't know what to say to you. So the table I showed you before, most of the tables that you get in the industry, they do not contain this part. Okay, they do not have this part. They only have this part here, these cute numbers here. That's what they give you because they don't necessarily understand why this is the case here. All right. So again, not trying to be demeaning, but it's important that you understand when you go to your bank or you go to any bar for your broker, don't necessarily believe they understand the things they're telling you, right? You got to equip yourself. I've learned this in life, and I'm not a skeptic, but you got to take control of your own stuff. So I mean, I'm never going to be a software engineer. I'm dabbled with software. I'm never going to be a software engineer. So we can't know everything, but you got to have a level of knowledge about some things. Okay, let me move on. So because lenders treat accelerated payments separate to normal payment privileges, okay, we'll talk about that in a second. Accelerated payments have almost taken a mythical proportion. Like you'll go to banks and they'll say, oh, would you like to make rapid bi-weekly payments? Like, I would like to do that. And magically you pay your mortgage off 2.5 years quicker. It's not because of the bi-weekly payments. Here's why. Accelerated payments is simply an automated way of increasing your regular minimum mandatory payments, okay? And as you will see from the following examples, accelerated simply means a 13th monthly payment is added to your annual mortgage payments, right? And then divided over the number of payments per year as defined by your payment frequency. For arguments, for example, accelerated bi-weekly payments, the 13th monthly payment is divided by 26 and added to each bi-weekly payment. So now that you're paying your mortgage off quicker, because if you have a 5-year mortgage term, every single one of those 5 years, if you continue to pay accelerated biweekly or accelerated weekly, there's a 13th monthly payment added onto your mortgages and divided over the 26th payment if you're buying biweekly accelerated, right? So that's how it works, okay? So again, be careful when banks say, well, would you like to say rapid biweekly or whatever else like that? It's the same thing as accelerated, okay? They just give it a cute name, all right? So don't be confused by that. Okay, the accelerated effect, as we said, it accelerated biweekly pays your mortgage off quicker, or accelerated weekly to pay your mortgage off quicker, where biweekly or weekly does not pay your mortgage off quicker. Okay, cool. Now here's the funky part, right? So other accelerated payments. So clients will come to me and say, look, Jacques, I'd like to pay bi-weekly because I pay my mortgage off quicker. And I go, what's convenient for you? And I go, I really would like to pay monthly. And they go, but I'd like to pay my mortgage off quicker. And I go, how about we set up accelerated monthly payments for you? And I go, what? You can't pay accelerated monthly, Jacques. And I go, you're right. But if you have the right mortgage, we can actually set it up like with the equivalent. Watch this, okay? So most banks limit their accelerated payments to bi-weekly or weekly. And as I said before, I think it's partially because there's no cute ratio to convert them. And so the average person in the front of the bank doesn't do that. So I think that's the reason. I'm not sure, okay? So once you understand what accelerated means, as we discussed, you can actually calculate your own, and you'll actually probably run circles around the bank. They'll probably think you're from Mars, okay? But basically what happens is you can calculate the other ones. For argument's sake, let's take monthly accelerated. Remember, to make it accelerated, we take your monthly payment, we multiply it by 13, and then you divide it by the amount of payments per year. Monthly payments are 12 payments per year, right? So we take the monthly payment, multiply it by 13, divided by 12. Now, here's the kicker, and we'll talk about it. You cannot set up, quote unquote, accelerate monthly payments with your bank if your mortgage does not allow you to do that, okay? And we'll talk about some of the benefits of doing it. So the right mortgage, again, we talk about life cycle cost of a mortgage. The right mortgage gives you flexibility. A killer rate most likely will not, okay? And I can tell you now, there are, I do not know one of my clients, not one of my clients that have paid their mortgages off quicker, have focused on interest rate. Okay, I've yet to see somebody who is absolutely over-focused on interest rate at the cost of everything else that pays the mortgage off quicker than anybody else. Okay, so one of the great things about other payment frequencies like biweekly, semi-monthly, stuff like that is you can actually line up your mortgage payments with your salary, which is pretty cool. So what some clients will do is they'll say, hey, Jacques, I get paid on a Thursday. Can you please make my mortgage payments come out on every 2 weeks on a Friday, so that they know their salary is the day before and they get to pay it the next day, which is a great, awesome feature to have, okay? Okay, so let's review some of the pros and cons of non-monthly payments, okay? So number one, most obvious one I would say is payment alignment. If you get paid, most people actually get paid bi-weekly, weekly, or semi-monthly, and not monthly. Actually, monthly, sorry, people are actually minority here, okay? So while monthly payments are, as I said, they're the standard payment. They're always available. It's kind of nice to be able to align your salary with your mortgage payment, okay? And as I discussed before, and you'll see in examples a little bit later on, is you do biweekly, semi-monthly, and weekly. You do save a little bit of interest. So that's, I mean, it's not nothing. It's not bad, okay? And of course, you have flexibility. So if somebody wants to start their mortgage with monthly, but 4 months later they want to change to biweekly, you can do that. Or if you want to then later change back to monthly, you can do that. But again, watch your mortgage's terms and conditions. Don't assume you can do that. Okay, very, very important. Okay, so some of the cons are, it is sadly considered to be a privilege. In other words, as I said before, if you are biweekly and for some reason you miss a payment, they have the right, the bank has the right to ask you to go back to monthly payments. Okay, so important to understand it. The other thing is there's more I would say the major reason why people choose monthly pay, some people choose monthly payments over biweekly or anything else, is because they go, Jacques, I just don't want to check every 2 weeks that there's money in my bank account. Okay, I just wanted to come up once a month, and I can relax the rest of the month. Okay, and that is a very legitimate way of doing as well, right? So if you take weekly payments, then 4 or 5 times a month, that payment's going to come out of your bank account. And of course, if you manage your money, you should be fine. But it's some people just like, I don't want to worry about it. It just comes out once a month. Okay, so accelerated payments. Some of the pros about that, it really is a mortgage-free. You pay your mortgage off quicker, right? So you'll see in a second, you can pay like 2.5 years quicker. You pay your mortgage 2.5 years quicker. You can do that. So that's a significant benefit of doing that. So in other words, so many people will say, let's talk about actually number 2 here. It's accelerated payments. Because it's accelerated biweekly, it's kind of like built into that payment frequency, is you kind of sit and forget your mortgage-free plans. Okay, so many people will say, Jacques, I really want to pay my mortgage off quicker. Not crazy, but I want to pay off quicker. And the problem is they get, 4 years down the road, and like, oh shoot, I forgot to make those changes. And so then they lose the out a little bit. So it's a kind of a great way of set and forget and pay your mortgage off quicker still. Okay. Prepayment privileges. Now, this is important depending on the right mortgage. Very, very important. Some banks will, so let's just say this is your normal payment year, okay? And now you pay accelerated biweekly. So once you add a little bit of payment here, okay? Some banks will say, well, we don't consider that, because most mortgages will give you a mortgage I get from my clients are typically 20% per year additional payments, okay, or extra contributions, okay. So what happens is some banks will say that accelerated biweekly is part of that 20% you pay off. Other banks will go, no, we still give you an additional 20% over and above that. So if you really want to put your mortgage-free plans on steroids, then guess what? Then you want to do if you set up your accelerated payments right from the closing date. So let's just say your mortgage closes on the 1st of October. From day 1, you make your payments accelerated biweekly, not just biweekly, accelerated biweekly. Then some banks will allow you to do 20% over and above your accelerated, okay? Now 20% is a lot, but it is kind of a nice way to kind of really get a little bit extra out of paying your mortgage down quicker. Okay, so it's a nice one. But again, few banks do that, but it's available. So some of the cons of accelerated, it is unfortunately the automated way is limited to some payment frequencies, not everybody. As I said, it's only available for bi-weekly and weekly. You don't get accelerated monthly. Officially, you don't get accelerated weekly monthly payments, okay? And it's not customizable. You can't say, you can only take, accelerate means you take one monthly payment every year. You can't say, well, Jacques, can you just take like half a monthly, but you cannot do that, okay? So it's basically a monthly payment added to all your payments every year, or it's nothing, right? So that's the sad thing. You can't really customize it, all right? So important to note that. Okay, so here's we're going to play around a little bit, all right? So accelerated monthly or semi-monthly payments, as we said, do they exist? They don't. So if you went to your lender and said, I'm looking for accelerated monthly or semi-monthly, they're going to look at you like you got 6 heads. And so do they exist? Of course, you can calculate them. And if you have the right mortgage, very, very important. If your mortgage allows it, you can set them up. So basically all you do is, let's take that $1,000 a month. And if you want to calculate accelerated monthly, you take 1,000 times 13 divided by 12. So if you basically, remember we already established, bi-weekly does not pay your mortgage off quicker than monthly, okay? So in other words, so then from a mortgage-free point of view, bi-weekly versus monthly is kind of the same, right? But if you want to pay your mortgage off quicker in an automated way, then with the right mortgage, we can set it up as $1,083.33 in this example. So somebody who says, I really want monthly, but I want to pay my mortgage off quicker as well. in an automated way, although that really monthly accelerator doesn't really exist, we can, for the right mortgage, we can actually set it up like that. And equally semi-monthly, you just take 13 divided by 24. It's a kind of a strange ratio, but nevertheless, you can see we can set it up like that, okay? So that's important for you to know that so you can play around with it. Cool? All right, so how would you choose a mortgage payment frequency and payment? Okay, so first of all, I would say look at convenience, okay? So you get paid bi-weekly and you would like to line up your mortgage payments with your salary, so that way you know that there's going to be your mortgage payment either comes out on the same day as your salary or the day after your salary, so you know you're set up, you're good to go, everything is great. Okay, so that's one way. The other one is cash flow. As I said, some people go like, you know what, I just want to check my bank account once a month, and so cash flow is really, really important to them, so they just choose monthly because there's going to be money in the bank account once a month, okay? Accelerated payments, if you want to expedite your mortgage-free journey and you don't want to even think about it and you just do a set and forget, it's a great way of to be able to set that up for you, okay? Now, remember, most banks, not everyone, you want to check this, will allow you to do bi-weekly and then later in the mortgage make it accelerated bi-weekly. You should be able to do that, but don't assume it, always check. Okay, cool? Okay, so this is let's tie it all together with some examples. Okay, so I'm going to try and make this a little bit bigger for you. The proof is always in the pudding, right? Okay, so hopefully you can see that. So what I've done here is I've basically done 6 columns. Okay, and again, these are all semi-annually compounded. All right, I've taken exactly the same mortgage. See here, $900,000 house, $315,000, and you can see all of them $585,000 mortgage. Okay, all 25 years. The only thing I played with here is I played with the payment frequency. So if it's a monthly payment, 3,267.15. Now watch. You pay $125,000, 400 in interest. You pay this much principal off. The balance after 5 year, it's a 5-year term in all the examples, is 514,371, and you'll have 20 years left. Now, if you take a semi-annual payments, remember this is 24 payments, right? And this is 12 payments. Watch. You can see here, slightly less, $185 less interest, but the principal you pay off is the same amount, and you can see your balance is exactly the same at the end of 5 years. Okay, no change there. So now let's look at bi-weekly. Now this is 26 payments, right? And you can see there slightly less interest here also, and there's the reason is because remember, compounding, if this is the year, every 6 months there is a compounding, right? Every 6 months interest gets added to interest 6 months here. With monthly payments, there is 5 payments, right? With bi-weekly, the reason why you pay slightly less interest because there's more payments, so you kind of beat it a little bit, but your payments, the same amount goes towards the principal. That's why it's slightly different on the interest here, okay? And you can see your balance is the same again, same amortization. Now here's where it gets funky. If you do accelerate bi-weekly, and the reason for that is because it's still 26 payments, but we've got a 13th monthly payment in here, right? That's why it pays it off quicker. And you can see here, the interest is now less. The interest is only less because as the balance gets paid down more rapidly because of the 13th monthly payment for every year, obviously you calculate interest on a lower balance going down, right? And you can see here, that is the balance after a significant balance here. And of course, now you're not ending at 20 years, you're going at 16 years and 8 months, which is pretty cool in an automated way, right? And so that's not a bad idea, right? So weekly again, you can see, let's compare 125, 115. Again, little bit less here. And the balance, however, is the same as all the other non-accelerated payments here. But if we do accelerated weekly, now you can see, of course, and you can see, you should compare this one to this one here because they are closer because they both accelerated. Now, of course, this one, it's not quite 8 months. It's not 16 years, 8 months. It's like 16 years and 7 months and 2 weeks or something like that. It's not quite exactly the same. But you can see the evidence is clear here. You don't pay your mortgage off quicker with straightforward more payments a year. You pay it off quicker when you make extra payments through the accelerated way of doing it. Now, if you did a accelerated monthly, if your mortgage allows it, then you will have similar results as you would have for the accelerate or the accelerate biweekly or accelerate weekly. Does that make sense? Hopefully it does. So you can, for your next party trick, you can, and people say, oh, you pay mortgage off quicker when you pay bi-weekly. You go, nope, not true. Okay. Good luck with that party trick, by the way. Right. So, but you can see it is not true that simply paying, bi-weekly pays your mortgage off quicker. It really does. You save a little bit of interest, but you don't pay your mortgage off quicker. Okay. So, really, the difference is making, if you want to pay your mortgage off quicker, sure, use bi-weekly, weekly, or any of those things, or those payment frequencies. But if you want to pay your mortgage off quicker, you need to make extra payments either through the automated accelerated method, or making lump sums or prepayment privileges. Okay, as is our habit, we look at the markets these days. Okay, so we're stepping aside from, I'm going to still allow for some questions in the second year, but let's start. Let's walk away from the presentation for a second and go into the markets. So as a reminder, that fixed rates are set by the market, okay, by bond deals, by the market, and it's a live tracker. It's not determined directly by the government, okay? As much as the government's announcements will affect it, the government does not determine bond deals directly through the Bank of Canada. It doesn't do that, okay? So now you can see here, this determines fixed rate. And to determine a fixed rate loosely, you can't really do that, but a very, very loosely put, you take the bond yield and you add 1.5% to it, okay? Now, I've seen this vary between 1% and 2%. So again, depending on the time of the year. So in springtime, where banks are really competing against each other more, it goes more to 1%. And this time of the year, they're really quite sloppy because they're coming to their end of their financial year. And so then they are not as aggressive. But basically, you can see if you add 1.5% to that, you can see what's at 3.25 plus, so 4.75. That's what you kind of are getting roughly, okay? So that's the bond yield. You can see where it's gone. This is, by the way, this is COVID. This is COVID round 2, and this is essentially Omicron there. And the rest is the mess that we're supply chain, inflation, the conflict in Ukraine, etc., etc. This is what causing this. And there's also if you watch the news, there's also a certain some housing problems in China right now. Okay, so that's an important thing to understand. So the next thing we want to look at is this thing called inflation, okay? And so on the 13th of July, it was, I believe, the Bank of Canada increased rates by a whopping 1% on the upward cycle. We'll look at that in a second. And I was really holding my breath, and I'm so thankful to say that inflation calmed down a little bit, but I don't think the fight's over yet. So I really feel for the Bank of Canada, right? And the governor of Bank of Canada, I feel for that guy. Why? Because if you raise rate, you really got only bad choices. If you raise rates, you are going to make borrowing more difficult, okay? But if you don't raise rates, you're going to have inflation going crazy, right? And if you raise rates, you're going to push the economy into a recession. So it's a tough decision to make. But I believe it's the right. I'm not an economist, so I'm not trying to give you economic advice here, but I think it's the right thing to get inflation under control. Understanding that we had a 1% inflation rate in the beginning of 2021, right? So this is, for most people, I mean, I'm from South Africa or Namibia, and so if you said inflation is 7.6%, like, oh, I'll take 2 of those, man. That's not bad at all. We're in Canada, it's like, no, we don't like that. Let's go back down to the 1%, so 2%. That's much better for us. Okay, so here is then what you hear the Bank of Canada has raised its interest rates, okay? So on the 13th of July, it rose its interest rates by 1%. So what is this interest rate? Basically, what happens is we call this either the policy interest rate or the overnight rate. Okay, so what happens is the overnight rate is here. Each bank will add its own profit, and then the bank, each individual bank will call this their prime rate. Okay, so what the Bank of Canada adjusts is this thing here. Okay, this is what they adjust. Okay, and then to get your variable rate, they say prime minus blah 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 or prime plus. That's how you get to your variable rate. So if you are in a variable rate, this is definitely affecting you, okay? How much will the Bank of Canada? By the way, there are 8 meetings a year. The next one coming up, and we're all holding our breaths for that, is the 7th of September, okay? And there is certainly wide expectations that the Bank of Canada will raise again. Who knows what it will be? I have heard, I am not an economist, up to 0.75 again. Okay, so it must be pretty tough being available right now. I actually sent out a video about a month ago about variable. Do not panic, focus on affordability. Longer conversation, but that's where this is at right now. See, obviously you can see this is a significant climb from January 2026. Okay, so where are rates at right now? If you buy a house, you cannot quote one rate anymore. If you buy a house for under $1 million and you put either less than 20% down or more than 35% right now, you can expect that's a rate special right now. Some of the banks are sitting at 5 point something, okay? If you want a 30-year amortization, you're probably going to be closer to this interest rate here, okay? On a fixed rate, 5-year fixed. So for prime, not all banks are the same. That's another thing. We think we hear prime rate, we think it's some government rate. It is not. Each bank can create its own prime rate, right? So most are sitting at 4.79. So yeah, sorry, 4.7 is the prime rate. So a 5 years adjustable is at 3.8, so prime minus 0.9, and a to round about prime minus 0.3 to 4.4%. That gives you a sense of where the market is at right now. So why is this so important right now? It is important from a point of view that, you know, the last time I believe that we had interest rates in the 5% here was, I think, 2006, 2007. Okay, so what's so important about this? Well, that's like, you know, do the math. It's 16 years ago, okay? So now with somebody who's 26 years old today and sees a 5.19 interest rate, they've only been used to 1 point somethings and 2 point somethings and 3 point somethings, not even 4 point somethings, okay? So they think they've never seen a 5%. They think the sky is about to fall, right? They think it's horrific because they've never seen it. But we are actually still historically low. Our interest rates are still historically low. Now, house prices are a lot more. That's the problem, right? And so for me, I'm not going to try and speculate where house prices are going to go, but we'll have to see so if you're in the market to buy, there's 2 things you want to look for, right? As rates go up, then obviously typically a housing market settles down a bit. So there's some kind of breaking point that even if the rates are higher, if the house prices come down to a certain level, you'll almost be in an equal playing field as if rates were low, but prices were higher. Okay, I really want to thank you so much for joining. This will be on our website fairly shortly. You can reach out to us here at any of these places here. This is my cell phone. I don't hide from you. So if I can help you, please do give me a call or email us also here. Our email address here is shared by all my entire team, so everybody sees it there. So thank you so much. I don't see any questions right now. So thank you so much. I really appreciate you taking the time to join us tonight. Okay. Take care. Have a good one.